Big name stocks are great, but if you're really looking for potential growth, small cap stocks could be your secret weapon. And today, I'm taking a page out of Warren Buffett's playbook to find the best buy and hold small caps that are flying under the radar right now. Why small caps? Well, these aren't the mega corporations we hear about daily, and that's exactly where the serious growth potential lies if you're patient. With the right pick, a small company today could become tomorrow's big winner, offering huge returns for those patient enough to hold on. In this video, I will show you 10 of the best small cap stocks that are worth buying right now. I've done the heavy lifting with all the research to make it simple for you. In the end, I will show you a small cap stock that has the potential to turn a $10,000 investment into over $1 million valuation, paying you over $16,000 in monthly income. You might be wondering why small cap stocks make sense in today's market. Here's the thing. While large cap stocks provide stability, small caps have the potential for explosive growth, especially in times of economic recovery or market shifts. Right now, we're seeing some really favorable conditions for small cap companies. With the Federal Reserve easing up on interest rate hikes and even hinting at potential rate cuts, borrowing costs are coming down. This is a huge win for small cap companies, which often rely on financing to fuel their growth. Lower interest rates make it cheaper for these companies to expand, invest in new projects, and boost their profits. Add that small caps tend to outperform larger companies during economic rebounds, and it's clear they're positioned to benefit. It all comes down to a company's market capitalization, basically the total value of all its shares. Small cap stocks typically fall in the range of $300 million to $2 billion in market cap. These are companies that aren't as big or well known as mid-cap or large-cap companies, but they have tons of room to grow. Small caps are often at the early stage of development, but they're established enough to have a solid business model and growth potential. Think of them as companies on the rise. They've passed the initial hurdles of survival and are now looking to expand. That's what makes them so attractive to long-term investors. They're small enough to be under the radar, but they have the potential to become so much bigger. Up next, I will show you the top 10 small cap stocks ranked from good to absolute gold mines, based on their potential to add value to your investment. Alright, first up at number 10 on my list is Haverty Furniture Companies Incorporated, or HVT. Now, this might not be a name you're familiar with right off the bat, but this company has been around for a long time, over 135 years in fact. They're a major player in the home furnishings game, with more than 100 stores spread across the US. They focus on high-quality, durable home goods that have kept them resilient through all kinds of economic ups and downs. So, why does Haverty make sense as a buy and hold investment? Well, first of all, their fundamentals are solid. We're talking about a strong balance sheet, low debt, and consistent revenue generation. And if you love getting paid to hold a stock, here's the good news. Haverty is a dividend-paying company. That means not only do you get to benefit from any future price appreciation, but you're also getting a little extra income along the way. Let's talk numbers, because I know that's what you're really here for. If you invest $10,000 into Haverty today, after 1 year, your investment could grow to about $10,498. Not bad, right? But it gets even better. If you hang on to it for 10 years, your $10,000 could turn into $17,549 with all dividends reinvested. After 20 years, we're looking at over $38,000. And if you're in it for the long haul, after 30 years, your investment could balloon to $114,000. By the end of that 30-year period, you'd be earning over $12,600 in dividends, which breaks down to a sweet $1,051 a month just from those payouts. Next up is ConnectOne Bancorp, or CNOB. A smaller regional bank, but this is where small cap investing gets interesting. These kinds of companies can often fly under the radar, but they have the potential to deliver substantial long-term returns if you get in early. ConnectOne is all about community banking, focusing on personal service and building strong relationships with local businesses and individuals. What sets them apart is their balance between traditional banking and innovation. which allows them to compete with larger banks while maintaining that personal touch. From an investment perspective, ConnectOne's fundamentals are strong. Their balance sheet looks good, they've maintained solid earnings, and most importantly, they pay dividends. For those of us following a buy and hold strategy, a dividend-paying stock with growth potential is exactly what we're looking for. Even though the banking sector can be subject to the whims of interest rates and economic cycles, ConnectOne has shown resilience, continuing to grow even in challenging times. Now let's look into the potential future returns. If you were to invest $10,000 into ConnectOne Bancorp today, after 1 year, your investment could grow to around $10,520. Hang on to it for 10 years, and that same $10K could turn into $18,346. But here's where it gets exciting. After 20 years, your investment could be worth $46,000. And after 30 years, you're looking at over $219,000. By that time, you'd collect more than $34,000 in dividends, which would give you an extra $2,874 in your pocket every month. Not a bad way to build wealth over time. Now let's talk about Shoe Carnival, or SCVL. This one's a bit of a sleeper hit in the world of retail. While you might think of big name brands when you think of shoes, Shoe Carnival operates in a slightly different lane. They focus on offering affordable brand name footwear in a fun, family-friendly environment. Their model revolves around providing great deals, often through flash sales and special promotions right in the store, which keeps customers coming back. In the retail sector, where competition is fierce and margins can be thin, Shoe Carnival's approach helps them stand out. They've built a loyal customer base, especially in suburban and smaller markets where they dominate. What's also impressive is how well they've adapted to e-commerce, blending in-store promotions with online sales to cater to different customer preferences. This adaptability has kept them relevant in an ever-changing retail landscape. Retail can be a tough space to navigate, but Shoe Carnival's focus on affordability and customer loyalty makes it a stable choice for long-term investors. Now let's talk about future potential. If you were to invest $10,000 into Shoe Carnival today, after 1 year, your investment could grow to $11,136. That's a nice start. But here's where things get interesting. After 10 years, that $10K could grow to $29,000. And after 20 years, it could reach $86,000. If you're willing to hold on to it for 30 years, you're looking at an incredible $252,276. On top of that, you'd collect around $3,000 in dividends over that period, adding an extra monthly income of $257. We're halfway through the list, but don't forget, at the end, I'll be showing you a small cap stock with the potential to turn $10K into over $1 million, paying $16,000 in monthly income. Next on the list is Global Industrial Company, or GIC. This business specializes in providing all kinds of equipment and supplies that businesses need to keep running, from shelving to office furniture, to tools to storage solutions. They're essentially the backbone for many companies, providing the infrastructure that businesses rely on to operate efficiently. What's interesting about Global Industrial is how they've carved out a niche in their very broad market. Their focus on B2B, or business-to-business sales, gives them an edge, and their strong e-commerce presence has helped them stay competitive in a space where many traditional suppliers are struggling. As companies continue to streamline and expand their operations, Global Industrial has positioned itself to capitalize on this ongoing demand. From an investment perspective, Global Industrial checks a lot of boxes. The company has a solid balance sheet, minimal debt, and consistent earnings growth. The industrial sector is known for its stability, and Global Industrial's role as a supplier to businesses in multiple industries helps diversify their risk. That makes them an attractive buy and hold candidate, especially if you're looking for a reliable income over time. Let's break down what your future investment might look like. If you were to invest $10,000 in Global Industrial today, after 1 year, your investment could grow to around $11,000. After 10 years, that $10,000 could become $27,000. Fast forward 20 years and it could be worth $84,000. Now if you hold on to it for 30 years, you'd be sitting at an impressive $299,924. By that 30-year mark, your dividend income would add up to about $19,515, giving you a nice monthly payout of $1,626. Next up on my list is Papa John's International, or PZZA. This is one of the more recognizable names on our list, and for good reason. Papa John's is the fourth largest pizza delivery company in the world, known for its focus on quality ingredients and a catchy tagline: better ingredients, better pizza. But behind the pizzas, there's a lot more going on in terms of business growth and long-term potential. What sets Papa John's apart from other fast food giants is its ability to innovate and expand its presence, especially in international markets. While they have strong competition in the US, their international growth has been a major driver of revenue in recent years. Papa John's has been expanding into untapped markets, which brings with it opportunities for further scaling. Papa John's pays dividends, and their balance sheet reflects solid financial health. This makes them a strong candidate for anyone looking to follow a buy and hold strategy. Plus, fast food has this unique stability to it. Even in tough economic times, people will always want pizza. Now let's get into the numbers. If you were to invest $10,000 in Papa John's today, after 1 year, your investment could grow to $10,628. Not a huge leap, but hang on. After 10 years, that $10,000 could turn into $20,797. And if you hold on to it for 20 years, you're looking at $64,950. But here's the kicker. If you stay invested for 30 years, your initial investment could grow to a whopping $416,000. But that's not all. You'd also collect $77,000 in dividends, which breaks down to a very healthy monthly payout of over $6,000. That's serious passive income, all while your investment continues to grow. Now let's shift gears to the tech world with Sapiens International Corporation NV, or SPNS. This company might not have the same level of brand recognition as some others, but they're a major player in a very specific niche: insurance software. Sapiens develops software solutions that help insurance companies manage everything from policy administration to claims processing, underwriting, and more. Basically, they provide the technology backbone that keeps insurance companies running smoothly. The insurance industry has been undergoing massive digital transformations in recent years, and that's where Sapiens shines. They're helping insurance companies modernize their systems and keep up with the fast pace of technological change. The demand for this kind of service is only growing, and Sapiens is in an excellent position to capitalize on it. As more insurance companies adopt their platforms, Sapiens' growth potential increases significantly. The tech industry can be volatile, but Sapiens operates in a stable and essential sector, insurance, which adds a layer of security to their growth potential. Now let's talk about what your future returns could look like. If you were to invest $10,000 in Sapiens today, after 1 year, your investment could grow to $11,364. Fast forward 10 years, and that $10,000 could become $35,000. After 20 years, you could be looking at $122,000. And if you're in it for the long haul, after 30 years, your investment could grow to an impressive $417,000. You'd also earn $3,372 in annual dividends. Next on the list is CTO Realty Growth, or CTO, a company rooted in real estate and property growth. Now, if you're into real estate investments but want something with a little more punch than your typical REIT, CTO Realty might be worth a closer look. They focus on owning, managing, and developing a diverse range of income-generating properties, including retail, office, and mixed-use spaces. What makes CTO particularly interesting is their approach to recycling capital by strategically selling properties and reinvesting in new opportunities. Real estate is often considered a cornerstone of long-term wealth building, And CTO Realty offers a way to tap into this space while benefiting from the company's active portfolio management strategy. By selling off high-value assets and reinvesting in new properties, CTO has been able to grow its portfolio, and by extension its revenue. This makes it a compelling option for investors who want to ride the long-term growth of the real estate market. CTO also offers an attractive dividend yield, which is higher than many traditional REITs. So what kind of returns could you expect with CTO Realty? Let's say you invest your $10,000. After 1 year, that investment could grow to about $10,468. Hold on to it for 10 years, and that could turn into $18,395. After 20 years, it could grow to $57,279, and if you're committed to the long haul, after 30 years, your initial $10,000 investment could balloon to $478,000. Not only that, but over those 30 years, you'd collect $112,668 in dividends, which means you'd be getting an extra $9,389 a month in dividend income. That's a hefty return for a real estate investment, and it shows just how powerful compounding dividends can be. Next on my list is DHT Holdings, or DHT, a company that operates in a very specialized and essential sector, oil shipping. DHT owns and operates a fleet of large crude oil tankers, playing a critical role in transporting oil across the globe. While oil and shipping might sound like volatile sectors, DHT has established itself as a key player, especially in the transportation of crude oil via very large crude carriers, or VLCCs. What makes DHT particularly attractive as a long-term investment is its impressive dividend yield. With oil demand continuing to drive global economies, shipping companies like DHT are essential in ensuring that supply chains stay operational. Yes, the oil market can be cyclical, but DHT has navigated these ups and downs with a smart business model focused on operational efficiency and strategic fleet management. So let's break down what an investment in DHT could look like. If you were to invest $10,000 into DHT today, after 1 year, that investment could grow to $10,978. After 10 years, and your investment could turn into $28,000. After 20, you're looking at $103,000. And if you stay in for a full 30 years, that investment could grow to an impressive $569,193. But it gets even better when you factor in dividends. The investment would be paying $77,564 in dividends, which means you'd have an additional monthly income of $6,464. At number 2, I have the healthcare sector LeMaitre Vascular, or LMAT, a company specializing in medical devices that target vascular disease. This company is focused on developing and manufacturing products for the treatment of peripheral vascular disease, which affects blood vessels outside the heart and brain. As the aging population continues to grow, the demand for vascular treatments is expected to rise, positioning LeMaitre Vascular as a major player in this expanding market. What makes LeMaitre so compelling as a long-term investment is its innovation and specialized focus. The company consistently brings in new, high-quality products to market, catering to a specific and critical need in the healthcare sector. In an industry where demand is steady and often growing, LeMaitre's portfolio of devices puts them in a strong position to benefit from the aging demographic and the increasing prevalence of vascular diseases. From an investment perspective, LeMaitre has seen strong financial performance over the years. They've posted impressive revenue growth, and their solid balance sheet allows them to reinvest in R&D, fueling further product development and expansion. While their dividend yield is lower than some other companies on this list, their rapid share appreciation more than makes up for it. For buy and hold investors, this is the kind of stock where you're betting on long-term growth in both the company and the broader healthcare market. Let's break down what an investment in LeMaitre might look like. If you put $10,000 into it today, after 1 year, your investment could grow to $11,574. Over the next decade, that $10,000 could increase to $42,000. Sticking with it for 20 years, and your original investment could be worth $178,000. Now, if you're committed to holding for 30 years, you could see that original $10,000 investment balloon into $741,000. Although the dividend yield is modest, LeMaitre's rapid share price growth drives most of this return. Over 30 years, you still collect about $1,458 in annual dividends. The real star here is capital appreciation. LeMaitre's ability to consistently grow in a high-demand, high-need market makes it a potentially powerful investment for those willing to think long-term. Rounding out our list and taking the top spot is Capital City Bank Group, or CCBG, a regional bank with deep roots and a strong presence in the southeastern United States. While smaller banks don't always get the spotlight, they're often offering unique opportunities for investors, and Capital City Bank is no exception. It has a 100-year history of serving its local communities with a range of financial services, from personal banking to business lending, which gives it a loyal customer base and a stable revenue stream. What makes Capital City Bank a compelling buy and hold investment is its focus on conservative growth and a well-managed balance sheet. Unlike some larger banks that can be exposed to riskier ventures, Capital City Bank has maintained a more traditional banking model, emphasizing responsible lending practices and local market expertise. This gives them a level of stability that can be attractive to long-term investors who value consistency over aggressive growth. From an investment standpoint, Capital City Bank has been quietly delivering solid results. They pay dividends, and with their impressive track record of dividend growth, this stock could become a strong income generator over time. Let's look at the numbers. If you were to invest $10,000 in Capital City Bank today, after 1 year, your investment could grow to $11,179. Fast forward 10 years, and that $10,000 could become $33,438. After 20 years, your investment might reach over $153,000. And if you stay the course for 30 years, you could be sitting on $1.2 million. The dividend growth here is particularly impressive. After 30 years, you'd collect about $192,147 in dividends, giving you a very comfortable monthly payout of around $16,000. That's a serious income stream, and it shows just how powerful compounding dividends can be. For long-term investors looking for steady, reliable growth with substantial dividend income, Capital City Bank Group is a hidden gem in the banking sector. Want to know how to turn a $10,000 investment into a multi-million-dollar portfolio with ETFs? Click the video on the screen to find out.